Following a period of substantial gains in the stock market, investors frequently begin to doubt the prospect of a prolonged advance. It's unnerving to keep putting money into stocks or ETFs that have lately increased in value but have a very low dividend yield. If such investments lose value, you may find yourself losing money over an extended period of time. Consider dividend funds that will continue to provide regular dividends to mitigate this risk. Even if the market falls 10% or 20%, the consistent cash flow will provide some security and confidence for dividend investors looking for consistent income. Dividend growth companies can be an excellent investment. However, they are not usually the highest yielding. Year after year, they continuously boost their dividend payouts. Here's a selection of ETFs that have been evaluated for profitability and are targeted toward consistent growth and dividends. So you'll be happy even if the stock market underperforms. Continue reading to learn about the highest yielding ETF on this list, which can give substantial passive income. Welcome to Cashflow Canvas, where we teach lessons about investment and money-saving techniques. If you want to make your financial future better, make sure to like this video and subscribe to our channel for the latest updates. VIG, Vanguard Dividend Appreciation ETF. VIG is a well-known dividend growth fund. It tracks the Nasdaq U.S. Dividend Achievers Select Index, which is a collection of companies with a 10-year track record of increasing dividends annually. It has nearly 200 stocks in its portfolio, including Microsoft, Walmart, Procter & Gamble, and Visa. Consumer discretionary is the most important industry, followed by industrials, healthcare, and technology. Although consumer discretionaries can be more volatile when the market varies, diversification across a large number of high-quality enterprises helps to ensure stability. Morningstar has given VIG a 5-star rating for the past 5 years. The dividend yield is approximately 1.7%, with an expense ratio of 0.06%. DGRO, iShares Core Dividend Growth ETF. DGRO requires at least 5 years of dividend growth, which isn't very lengthy in the dividend world, so expect some volatility. The fund only invests in companies that have an acceptable payout ratio or the percentage of earnings paid out annually. To further mitigate risk, DGRO owns nearly 400 different equities, including Verizon, Home Depot, Apple, and JP Chase, with financials being the largest sector held, followed by technology and healthcare. The dividend yield is approximately 2.3%, with an expense ratio of 0.08. WisdomTree U.S. Quality Dividend Growth ETF, DGRW. DGRW is a little different than most dividend growth ETFs, but it doesn't make it any less appealing. Instead of focusing on the past and previous dividend increases, it looks ahead to a company's potential and possibility of increasing its dividend. This makes logical sense because past results may not predict future outcomes. The research considers fundamentals such as long-term profits growth, return on assets, and return on equity, which are some of the criteria used to assess financial health. The major sectors are technology, healthcare, and consumer defense, with 300 businesses controlled such as Apple, Verizon, Coca-Cola, and Altria. The dividend yield is less than 2%, while the expense ratio is 0.28%. NOBL, ProShares S&P 500 Dividend Aristocrats ETF. A dividend aristocrat is a corporation that has paid and grown its dividend for 25 years in a row. These are well-known dividend stocks, such as 3M, Coca-Cola, Pepsi, Clorox, and McDonald's. They've been in business for a long time, have strong fundamentals, and investors buy the stocks because they know they can rely on them. The S&P 500 currently has roughly 65 equities that qualify on this list, with the majority of them being industrials, consumer non-cyclicals, financials, or basic commodities. The companies have consistent earnings, strong fundamentals, and lengthy histories of profit and growth, making it very probable that they will continue to make payments regardless of the economy. The dividend yield exceeds 2%, while the expenditure ratio is 0.35%. REGL, ProShares S&P MidCap 400 Dividend Aristocrats ETF. This ETF is similar to the S&P 500 Dividend Aristocrat ETF in that it only invests in firms having a track record of rising dividend payments. However, the S&P 500 only includes large-cap stocks, ruling out mid-caps. REGL also simply requires 15 years of consistent dividend increase. Because mid-caps tend to be newer and younger, having some exposure to smaller companies is a good idea because they are frequently overlooked. Investors are overly focused on purchasing the big brands they see everywhere, those that experts are continuously analyzing, and those that their friends and family are discussing. These are slightly more volatile than huge blue-chip alternatives, but that may simply indicate greater possibility. This portfolio presently holds roughly 60 equities, with the major sectors being financials, industrials, and utilities. It includes lesser-known brands such as Graco, Flower Foods, and Polaris. The dividend yield is approximately 2.3%, with an expense ratio of 0.41. SMDV, ProShares Russell 2000 Dividend Growers ETF. This is a small-cap equivalent of the preceding Dividend Aristocrat funds, with the exception that it just requires 10 years of uninterrupted dividend increase, which is still a long time for tiny and less established companies. This portfolio has approximately 75 equities, the majority of which are financials, utilities, or industrials. Most of the names are probably unfamiliar to you because they are little businesses that don't get much attention, such as Lithium Motors, Heritage Financial, and York Water. However, this does not imply that they do not present opportunities. In reality, they may be terrific assets that have not been overbought like some of the huge names we hear about on a daily basis. Smaller companies have greater room to grow than large corporations, albeit at a higher risk. The expense ratio is 0.41%, while the dividend is roughly 2.5%. VSDA, VictoryShares Dividend Accelerator ETF. This is a tiny fund that tracks the Nasdaq Dividend Accelerator Index. It has assets of only $330 million. It is invested in 74 large and mid-cap stocks. The companies are vetted to verify that they are likely to increase their dividends in the future and weighted accordingly. Nike, Target, McDonald's, and American Financial are among the top 10 holdings, with the major sectors being technology, healthcare, and consumer discretionaries. The dividend yield is approximately 1.4%, with an expense ratio of 0.35%. DNO, WisdomTree International Quality Dividend Growth ETF. This ETF invests in dividend growth firms that are based in developing and emerging countries other than the United States. It's a good idea to have some overseas exposure and avoid investing entirely in American companies. Most financial gurus recommend that you keep 15 to 25% of your portfolio in overseas holdings, dispersed across multiple nations and companies. DNL invests in 275 foreign stocks from Japan, Switzerland, the United Kingdom, Taiwan, India, and other countries. Its major industry is technology, followed by healthcare, industrials, and basic materials. The expenditure ratio is 0.58, and the dividend yield is approximately 1.7%. VUAM, Vanguard High Dividend ETF. This ETF offers a high dividend yield from one of the most recognized investment firms, if not the most reputable. It tracks the FTSE High Dividend Yield Index, which includes common stocks of firms that pay higher than average dividends. Over 400 equities are held, with Johnson & Johnson, JPMorgan Chase, and Procter & Gamble being the three largest. The largest sector is finance, followed by healthcare, consumer staples, and industrials. The dividend yield is the highest of those offered, at around 3.1%, making it a particularly well-diversified fund for people seeking higher income investments. As we conclude, I'd like to thank you for watching. I hope you found value in this video and learned something new, and I look forward to seeing you in our future videos. I would deeply value it if you could like this video and subscribe to our channel. Your support will help us to create more valuable content, and we can work together to secure your financial future. What are the key takeaways from this video that you can share in the comment section?